there. Okay. First of all, it's really great to be here with the CEOs of Africa's largest banks, and I have so many questions, and unfortunately, so little time. But I thought we just jumped straight into the perennial issue that I know has been raised in the previous panels, which is how do we fund Africa? Can we talk about the cost of capital? And I just want to point out that Africa Finance Corp estimates that the continent spends as much as $75 billion a year in additional borrowing cost, and it calls it the prejudice premium. And I wondered, just to start, how do each of you think about the premium that gets applied to Africa's debt? Do you think that there's a perception tax, or do you think that the risk is priced fairly based on what we know today? Why don't we start at the far end with you, Sam?
Thank you very much, Jacqueline, and it's wonderful to be here and to be with friends and colleagues. It's actually scandalous. I mean, there's no other way to put it. As you correctly point out, you could say that the additional borrowing costs wipe out about 2 percentage points on African GDP across the board. Take a country like Cote d'Ivoire. It is similarly rated to Serbia, and yet its issuance, its debt, is priced at above 50 basis points more than Serbia's. You take South Africa. On the data, South Africa should be rated by the ratings agencies as a triple B. It's currently rated at double B minus. Generally, African sovereigns are rated about 4 rungs lower than they ought to be, just based on the data. Based on the data suggested by the ratings versus the actual default data, there's a mismatch, and it's inexplicable. The data just does not support the ratings, and therefore the costs. And in the case of South Africa, that additional cost is about 50 to 70 billion rand per annum. It's scandalous, and ought to change. The couple of things that are happening, there is a debate happening with various standard setters and ratings agencies, and we're arguing that they should understand the continent better, and they've taken steps in that direction. Moody's, for example, bought GCR. They've got better representation on the African continent. S&P has upped its representation in South Africa. That's a good thing. And on the other hand, there's work to be done by African sovereigns, improve investor relations, improve budget transparency, improve monetary policy management, have an independent central bank, and let its currency float. And perhaps let me stop there. It's scandalous.
Yeah.
It's the opposition.
Do you want to come in?
Yeah, sure. I fully agree with Sim, and I think this is something I've advocated at every opportunity I've had to speak on it. The challenge, however, is I think Africa also has a role to play in this large conversation. Initially, the conversation was, do we get local rating agencies for African businesses, for African sovereigns, and tell our own story differently? So jettison the S&Ps, Moody's of this world. But it would be akin to a bad student or a student who is not passing an exam and saying, well, you know what, let me set a different exam for myself. But that's not what we want, because we think the conversations are real, and we should force the conversation and avoid the noise level that exists within the continent. So one negative news happens in the continent from a market where people really don't understand where the negative news is coming from. The noise level is much enhanced, and of course, on the back of that, pricing of that risk is then put into consideration. I have a thing that the continent has something that it can do itself. There's so much stranded capital within the continent, right? So all of this makes sense, and the premium that we have to pay makes sense because we all have to go externally to borrow. Our sovereigns are going into the Eurobond market to borrow. Nigeria just had a successful outing about 2 weeks ago. We're all celebrating it. But there's so much capital in the continent that could have been diverted or invested into sovereigns like Nigeria, Ethiopia, Egypt, other markets who require capital at this time. If we can find a way to catalyze capital that is stranded within the continent. I think it reduces the dependence on the ratings and having to go into the international market to raise debt or equity capital, as you said. We understand ourselves better within the continent, and I think the nuances of how risk is articulated, measured, and priced for will be a lot more different. Until we do that, I suspect we still have to keep fighting with the rating agencies, getting them to see reason. ECL models or credit ratings are supposed to be forward-looking, right? You take a bit of the history, you look forward as to where the market is and what could go wrong. Track record for most issuers is that they've had zero defaults. They've been repeat issuers into the market for 20-plus years. So on what basis
Can I come in on that?
Pricing?
That's a really good point, because Sim raised the point, the comparison between Côte d'Ivoire and Serbia. And some economists make the point that emerging markets, that many times they default less often, and when they do, investors get more back. And that in global project finance, Africa and the Mideast recover about 85%, which is the most anywhere in the world. So my question to you, Kenny, would be, if the recoveries are that strong and defaults are less, what keeps the Africa premium in place? And what's the one change that you think would actually reprice it?
I think you asked your question in a very appropriate manner, whether there's a perception premium. There is no doubt that there's a massive perception premium. And I think it is that perception that all of us need to work on and make sure that Africa is appropriately positioned, that the rating is based on the actual facts and the economic performance of each of our countries. And the negative implications of this perception premium is that it has a knock-on impact on banks, because our own credit rating is pegged on the rating of the country, which then has a consequential impact on our own customers. So it's not just about the sovereign. It's about the entire economies of our countries that effectively suffer from this negative drag. So we have to deal with this perception. But I think there are certain things that we also have to deal with as Africans, removing some of the internal obstacles that add an additional burden and add an additional cost ultimately to borrowing, to the ease of moving capital in between countries and across sectors. So we have to also own the part that belongs to us and do something about it.
Roosevelt, you mentioned that Nigeria went to the bond market, and there was an initial negative reaction in markets to Donald Trump's comments about sending troops to Nigeria over Islamist militancy. But after a very short delay, the government went ahead with the Eurobond offering that was a success. It was oversubscribed multiple times. And I guess my question is, what does that say about how the markets read the U.S. administration's intervention in global affairs, notably Africa? And I suppose I could ask the same question to your South African peers, given the year that's been.
Well, so I think, President Trump, and I'm sure somewhere in his mind, meant well. I believe. The idea of, he said it many times, that if people are persecuted anywhere in the world, he will have an interest and he will seek to intervene. So we thank him for that intervention. But I think Nigeria really did not need it at the time that it came through. We're just about to go to the market. And of course, as I said earlier, in Africa, unfortunately, we are managing fear, not managing risk. Risk is easy to put our hands around and, of course, mitigate. Fear is something that you just can't control. And I think that's what his message might have intended to cause. People will be scared as to all of the noise around Nigeria, what exactly is going to happen. Is the country going to burn down and X, Y, Z? But I think the markets were smarter than just the narrative. It's not my view as to what I think the investing public or investing market chose to do. The facts speak for themselves. So I think markets are more intelligent, and markets made a call. So Nigeria went out to the market to raise $2+ billion, ended up raising over $12 billion. And I think that's enough affirmation of how the markets perceive the Nigerian economy today and the prospects going into the future. So the current administration came in 2023, have pursued a transformation in the economy, and there's been a lot of policy reforms around energy, around currency, around power. And I think the market is responding to all of that. And I think to the point that Sim made earlier around just transparency of government, the monetary policy thrust is one where they're a lot more transparent, engaging a lot more with the investing market. I think Nigeria is beginning to see the benefits of the work that the government is doing through the transformation, and of course the central bank in its very transparent manner, what it's doing around monetary policy. So the market spoke, and I think we saw the results.
Would our South Africans agree with that?
Shall I go, Kenny?
Yeah, please go first.
Again, Jackie, what does the data say? At the beginning of the year, everybody thought South Africa would grow at less than 1%. They thought the African continent would grow closer to 4%, if not below. At the moment, the IMF and our economists, and I know Kenny's economists are saying the same thing, South Africa is likely to grow at 1.2%, the continent closer to 4.5%, countries like Kenya, Tanzania at above 5%, Egypt at above 5%. Why is that the case? Well, in large measure because the tariffs, as people had anticipated them, have not turned out the way people had expected. Firstly, they don't cover all the goods that people thought they would cover. Secondly, it's been a one-sided affair. Countries have not retaliated, but very interesting patterns are happening as far as Africa is concerned. The Global South is talking to one another. Just think of the number of dialogues, bilateral and multilateral dialogues that are happening. FOCAC, TICAD, the Saudi Arabians and the Africans, and indeed Americans and the Africans, and the EU and the Africans. What is the point? The point is, notwithstanding all of that turbulence, things are actually looking up for the African continent, notwithstanding the challenges related to the tariff wars and so forth. And it's our job, I guess, as leaders to look for opportunities for growth, even in all of that turbulence.
Can I actually, that's a perfect seg, because I wanted to make the point backstage where we were talking about the number of Western banks that have retreated from the region, and I want to talk a little bit about where you, the incumbents, lean in. So Access will double its asset base outside of Nigeria by 2027, and I think you're on a plan to pursue about half a dozen acquisitions this year. Roosevelt, where does this expansion strategy stand, and what's next?
Well, so I suspect my regulator might be listening to this. I do not plan to have 6 additional subsidiaries by the end of the year. So I think we've expanded our network. We benefited from the global Western banks who are leaving the continent, the likes of Standard Chartered, who have shrunk their operations in the continent. They exited 5 markets, and in some markets exited certain businesses. We worked with them and acted as a safe harbor for those exits that they had. BNP Paribas, SocGen, those entities are seeking to leave. I think if you look at the markets where they're leaving, take Gambia, for example. Standard Chartered was the only bank. I remember when I was in school and we were learning about banking in West Africa. It was the only bank for about 100 years. So they made the call for everything. Everyone banked in Standard Chartered, rather Standard Chartered, I beg your pardon. The minute there was local competition, homegrown competition, or West African banks or African banks who came into the market and were willing to compete, then the premium that they enjoyed started to disappear. And then, of course, the cost of compliance in those markets then did not make sense anymore, given how much premium they've had to let go. So we've seen them exit, and I think banks like us see those as opportunities. We understand the continent. We're willing to be local banks in those markets. We got into a market many years ago, Zambia, and it was strange for us to get into Zambia where there had been many banks, many global banks, and there were no credit cards in the market. It took us coming into the market and saying, you know what, you can do X, Y, Z and do it differently. I think the African banks are more vested in the continent and are not just there to scalp the market. And the more we see local banks or local African banks entering those markets and taking over from what traditionally were the incumbent Western banks. I think there'll be more impact within the local markets because we will offer full-scale commercial banking services. Okay. From retail banking, that is, to supply chain, to SME financing, all the way to corporate and investment bank. So the entire spectrum and not just to pick and choose. I mean, we also see the large global entities in the continent. We see 400 global entities, or global corporates rather, that do about $1 billion in revenue and more. About 350 are regional corporates. We could all choose to serve those counterparties and just stick to that, and we'll make money. But I think it's beyond making money for us as financial institutions, about how we capitalize growth in the various markets that we operate in.
So Kenny, you took over as CEO of Absa in June, and in August you told Bloomberg that you would finalize Absa's strategy within 2 months. So that was August, and we're mid-November, so we're past that deadline. Where are you today?
Yeah, no, the strategy has been finalized. So the deadline has been met. But the strategy focuses on the following areas. I think the first is you win or lose at the client interface. So we have to sharpen which client segments we want to focus on and make sure that we're able to create appropriate differentiation in the areas that we want to focus on. And that is true for all our businesses, retail, business banking, and CIB. The second element of our strategy is about strengthening the diverse nature of our business. We are still overly concentrated on South Africa, but there are massive opportunities that are presented by the rest of the African continent. And I think Simmons and Roosevelt spoke about some of these opportunities as represented by the GDP growth rates. The third pillar of our strategy is about accelerating the pace of modernization so that we can drive efficiency within our business, reduce the cost to serve, whilst at the same time ensuring that we're able to improve client experience and consequently, at the back of that client experience, be able to allocate capital more efficiently. And fourthly, it will take way too long for us to transform and modernize everything on our own. So we'll be looking at other opportunities of bulking up as and when those opportunities present themselves, as we are already doing in Uganda through the acquisition of the asset book of Standard Chartered. Will remain open and will be on the lookout for those sort of strategic inorganic opportunities, provided that they're digestible and they're complementary to what we do. Let me add just one point. On your question around geopolitics and the US and Africa, we are business people. I think we must focus on the client opportunity, on what we can do in support of our clients. Trade flows between South Africa and the rest of the world remain vibrant. South Africa is turning the corner, has been taken out of grey listing, the rand is strengthened, inflation is coming down, we have seen an upgrade by S&P on the South African credit rating. So there's a lot that is going on for the country. We must just focus on doing the right thing so that we take our own destiny in our own hands. Otherwise, we can be lost in the noise and lose sight of things that we can control.
So it's really rare for me to be on a panel where one person actually reported to another. And in this case, Kenny, you left Standard Bank in March and you took over as Absa CEO in June. What are you bringing over from the Standard Bank playbook to Absa?
Well, let me start by saying, it's in a family. And by the way, Simmons is my brother. At some point, you must let your brothers grow and go and explore the world. So it's actually a good thing. And in many respects, it's a positive to Standard Bank for having been able to do that. There's an unbelievable culture that one was part of within Standard Bank. Because if you have a positive culture and your people are energized, then suddenly you've got an army of unstoppable individuals. And certainly, that's something that I hope to bring to Absa. And we've started the process of re-energizing the team and ensuring that we've got our own culture that creates an army that is unstoppable.
Well, I have to ask Sim, what did Kenny do at Standard Bank that you most valued? And where are you happy to compete head-to-head now?
So firstly, let me start at an institutional level. Absa is formidable. They say in the classics, fortune favors the big battalions. Absa is massive. They've got a strong balance sheet, fortress balance sheet. They've got good people. They've got a good brand. And they're fiercely competitive. So if you take that capability with the excellence that is the executive that is Kenny Fihla, you have got something quite powerful. Kenny... And you'll say it's schizophrenic. So on the one hand, we worry intensely about the competitive dynamic because we know that Kenny is fierce, so he'll be tackling us on the sports field. So there's the one hand. But on the other hand, and more importantly, sitting here on this panel, it's a bit like a rugby team or a soccer team. In the league, we compete. When we represent the nation or the continent, we're on the same side. We are... So today and this week, Kenny and I and Roosevelt are speaking up on behalf of our colleagues, our industry, our clients, and the continent, and making a case for the attractiveness of the African continent. So what Kenny will bring is fierce competition, but he's a man of trust and faith, who I highly regard, but I'm scared of in the field.
So I was told in preparation of this conversation that, for Africa, if you're not committed to funding 3 areas, renewables, agribusiness, or infrastructure, you're really missing the point. And first of all, Sim, do you buy that, particularly on the renewables equation, given your other energy commitments? And if you don't agree with it, where are you prepared to go overweight in 2026?
So energy, 600 million people on the continent don't have access to the grid. So we need baseload. We need to do everything that we can to improve transmission, generation, and also distribution. So the Eskom and the DISCOs and the GENCOs in Nigeria remain very, very important. But the single biggest thing facing humanity today is climate change, despite what is happening in the public domain and the public discourse. And therefore, you need solutions that address that. At once, the access to power as well as dealing with climate change. And therefore, renewables are an important dimension to that. To change the proposition slightly differently, because the play is actually an infrastructure play. How would it be, for example, in this world where AI is becoming so important, how would it be if we had data centers built in Africa, in the Western Cape, where there's lots of wind and lots of solar? We need the copper. Well, the copper is just up the road in the copper belt. You don't have to transport it across the world. You've got great skills in the Western Cape. The same applies in Kenya. You've got geothermal. I'm told the engineering's easy. You just dig a hole in the Rift Valley, and the power just comes through. The copper is just up the road. You build your data centers. There. So the opportunities on the African continent are vast in that context, and it's our job, as Kenny and Roosevelt have said, to identify these opportunities and then motivate for the allocation of capital to those opportunities.
Yeah. And I see that clock dangerously ticking down, but I just want to ask one question about China, because the Minister Lamola, I listened to him speak in London a couple of months ago, and he was asked, you have to juggle your relationship between Beijing and Washington. Which do you choose if you have to choose? And he basically said, as a developing country, we don't get to choose. We're not in a position to choose. And my question is, with China so visibly active in this region, and you have Gulf capital rising, what that looks like for banking. And Roosevelt, very quickly, but Access opened a branch in Hong Kong to capture some of this Asia-Africa trade flow. How have you seen that augment?
Well, so I think I'll just step back a bit and look at this from a global value chain perspective. So Africa is still 6.3, 6.4% of global value chain. It means that there's so much more that can happen in our market. Just outside on one of the tables there, you had something Bloomberg had done that says 76% of cobalt is gotten out of DRC in Congo. So I went quickly to see what raw cobalt is about $880. refined and fully processed is about, on the London Metal Exchange this morning, is over $42,000. So you're talking $880 to $42,000 raw to refined. And DRC Congo has no play in that conversation, right? So about capital flows, our presence in Hong Kong's gateway to Asia, hopefully we're looking at that as a global market where we can attract cheap capital into the continent to help build the infrastructure that Africa needs to be able to then take full advantage of all the raw material that it has. It's a continent that is blessed with all of the things that we have. It just isn't making the right impact. With Congo alone, that can add what is almost 30% to their GDP, and that can transform the entire continent.
Sim, 10 seconds, if you can. Your retirement is on the horizon. I think it's the end of 2027.
Now you've ruined the friendship.
What's one defining achievement you want to have locked in by then? Just one.
To be on the upper end of the target ranges that we've set for ourselves and our shareholders, headline earnings per share above 10%, and return on equity above 20%.
Okay, that's very succinct. And finally, Kenny, can you name one risk that you're happy to own in 2026 and one that you absolutely won't touch?
Let me start with the one that we won't touch. I think I reflected on geopolitics. There's nothing that we can do about that. If I decide to be mad today and sane the next day, there's absolutely nothing that the rest of the world can do about that. So clearly, we have to stay out of geopolitics and focus on what makes commercial sense and follow our clients. I think the one that we definitely, I would want to own is I think there's a lot that we can do as Africans to accelerate the pace of opening up our own markets. And this is so important for us as banks, where we locate our IT infrastructure, how we're able to create economies of scale, how we're able to move people around in order to optimize the effectiveness in our respective countries and add value to clients. Unfortunately, despite the African Continental Free Trade Agreement, we still have policies and decisions that are made in many of our countries that are taking Africa backwards.
Gentlemen, thank you very much. We're going to take a break, but before you do, I think there's going to be a QR code right behind me. So that is to get a free trial of the Bloomberg terminal. So we'll leave that up for a minute. Otherwise, we'll go to a quick break. And please thank the panel. Thank you.